Let's get more on the markets from Mark Sebastian, founder of Option Pit and Karman Line Capital. Mark, great to see you. Talk to us about volatility. Is this a market, when we look at the S&P 500, where we're seeing big swings?
Yeah, it absolutely is. Over the last couple of weeks, we've seen average true range, which kind of measures how much the S&P is moving up and down on a daily basis, get up to about 1.2%. Now, without getting too deep in the weeds, the VIX measures how much the market thinks the S&P is going to move. The VIX is around 16. A 1.2% daily move is closer to a 19% daily movement, which tells me that options on U.S. markets are probably too inexpensive.
Too inexpensive. So if you were if you're a big holder of stocks and you wanted to sell puts or calls, you're not going to get that much right now?
Yeah, we have these giant covered call ETFs and mutual funds that are on a daily basis, weekly basis, monthly basis, selling option premium in a systematic fashion. And that's actually kind of changed markets a little bit, where, for 20 years, 40 years, the assumption was options are always overpriced. Options are always overpriced. With this kind of dearth of option selling from all of these funds, that's starting to flip, where we're seeing options on the S&P 500, the triple Q, the Dow, and the Russell 2000 underprice event risk. Classic example, going into the weekend, options were looking for about a $97 move on the S&P 500 between Friday to Friday. So think about that, $97. We've got a potential China deal. We've got, is the shutdown going to close or not? We have 5 of the Mag 7s reporting, the Federal Reserve, PCE. I mean, I don't know that we can have a heavier economic week, and markets are pricing at about a 1.5% move. The S&P rallied to $83 on Monday. That's kind of the way markets have shifted. And it's opening up brand new opportunities that, I don't know that the general public has caught up to. But, case in point, again, options are just simply too cheap as we head into the Federal Reserve. They're pricing in about a 75-point move between now and Friday. Again, we moved $80 yesterday, and we still have all this economic data in front of us.
That's interesting. I mean, we've had a huge rise in popularity here of ETFs that use a covered call strategy, supposedly to produce yield for investors. I'm always a little dubious about that. And actually, in some cases, they've underperformed plain vanilla indexes, but we won't get into that. But it's interesting to hear American retail investors, I guess mostly, are keen on these things, and it's infecting the entire option market.
Yeah, you look at that monthly quote unquote dividend that they pay out from the option premium sell, they look interesting. You have to be strategic about them. Do they have a place in a portfolio? Potentially, yes. Should that be a primary form of investment? No, because you're right. Covered call funds do tend to underperform because they capture most of downside moves. And then when we get a move like we did on Monday, they're going to miss a chunk of that upside. So is there a place for them in producing some income for older individuals? Yeah, strategically, yes. But should that be a form of primary investment? I do not believe so.
Give us your thoughts on the markets generally. Are you seeing signs of overvaluation in the big indices?
Yes, I am. What I would say is we might be at a seminal point for the chip space. Qualcomm over the weekend coming out with their new competitor for NVIDIA's GPUs. AMD striking that deal with OpenAI. All the changes that are going on at Intel. Commodity traders, what is the solution to high prices? High prices. Obviously, the cycle for these AI chips is a longer cycle. But my belief is that in a couple of years, maybe sooner, we may be looking at a glut of AI chips. Where would that come from? Well, how much faster are these able to get? You know, there is a point where you start running into diminishing returns. You have more competitors entering the market. And, you know, as AI build out does slow down a little bit, you have to wonder whether we run into a chip glut. And I'm not saying it's definitely going to happen, but that is 100% on the cards, and something as an NVIDIA investor that should be kind of haunting me in the back of my head.
Do you feel there's euphoria in the air now? Because eventually the limits for AI growth will be reached, or at least the growth will flatten off.
Yeah, what worries me about markets is that you know, a lot of people own the QQQ and SPY and believe that they're diversified. The top 8 stocks in the triple Q make up over 67% of its value. You know, that changes on a daily basis, so somewhere around 67%. Those same companies make up about 35% of the S&P. So if I own in my retirement a SPY and Q, I'm kind of over allocated to those you know, those top 8 names that have kind of taken over the market. I know it sounds kind of ridiculous, but the Dow Jones Industrial Average, the Diamond ETF, with only 30 stocks, when you look at it, it appears to be more diversified than the S&P 500 and certainly the triple Q. So what I worry about is the lack of diversification in the general public, and we get a sneeze in these kind of top 8 names and kind of takes the market down with it. You know, I'm kind of migrating some of my investments out of the S&P 500, which is cap weighted, and looking for equal weight investment opportunities.
Thank you very much. Always great hearing from you, Mark.
Thanks for having me.
Mark Sebastian, founder of Option Pit and Karman Line Capital.